When you think about the future of finance in Nepal, you probably think of QR codes and digital payments, right? Well, that story, it's just the tip of the iceberg.
This is an analysis from Alpha Business Media. You know that little chime you hear all over Kathmandu when a QR payment goes through? Yeah, that's not the fintech revolution. That's just the opening act. The real war, the one for a much, much bigger prize, is just getting started. So over the next few minutes, we're going to break down the 5 key strategic areas that are going to define this new battlefield. We'll look at the real target of this fintech war, the huge market failure they're trying to fix, the new weapon they're deploying, the regulatory standoff that's going to decide the winner, and finally, the 2 very different futures that are on the table for Nepal. All right, let's dive into the first critical point. This whole payments boom, it's actually been a brilliant piece of misdirection.
See, the common belief is that companies like East Sewa and Kalti are just fighting over who gets to process your utility bills or your coffee purchase. But honestly, that's thinking way too small. The reality is, the payments game itself, it's a low-margin business. It's just a tool, a way to get the data they need to attack a market that's way more lucrative.
So that begs the question, right? If it's not really about payments, what is this all about?
Well, the real prize is solving a massive, systemic failure right at the heart of Nepal's economy. And it's not a failure of markets, it's a failure of data.
$1 billion. That's the estimated credit gap for Nepal's small and medium enterprises, the SMEs. Think about that. $1 billion in unmet demand for loans. These businesses are literally the backbone of the economy, but they are completely, totally locked out of the formal credit system.
Now here's where it gets really interesting. It's about how you frame the problem. For decades, everyone's called this a market failure. The assumption was that banks just weren't interested. But the core insight of fintech is that this is actually a data failure. The market is there, it's huge, but the information needed to serve it, it's basically invisible to the traditional players.
And this slide just lays it out perfectly. Why can't the banks help? Well, traditional banks need formal documents, they need land titles for collateral, a clear paper trail, all things that most of these small businesses just don't have. Their world is cash-based, which makes them invisible. They're stuck in this financial no-man's land, too big for microfinance, but way too small and informal for the big commercial banks.
Okay, so if the problem is a lack of data, the solution has to be creating new data. And that is the fintech playbook in a nutshell. It's all about turning data itself into a new kind of collateral.
Which brings us right back to those digital wallets. The big misconception is that they're just payment companies.
But they're not, and this is the crucial point. They are data aggregation platforms disguised as payment companies. Every single QR scan, every bill payment, every transfer, it's a data point. The real business isn't the tiny fee on the transaction. No, the real business is collecting millions of these data points to build a high-fidelity financial profile of a business that until now was completely invisible. It's a classic Trojan horse strategy.
And this leads us to the key concept here, alternative data. It's a fancy term, but all it really means is the verifiable digital footprint left behind by a business's daily activities. This data, not a piece of land, is what fintechs are using to decide if a business is a good bet for a loan.
So this new collateral is built on 3 main pillars. First, you've got the obvious stuff, transactional data right from the wallets themselves. Second, you have e-commerce data. Think about it. A seller's rating on Daraz or their sales volume on Instagram, that's a powerful signal about how good their business is. And third, and this is probably the most powerful of all, is supply chain data. If a fintech can see how often a small shop restocks its Coca-Cola or its YY noodles, they get a real-time, up-to-the-minute view of its cash flow. It's incredible.
Okay, so this all sounds great, right? The technology is here, the market is just waiting. But the entire system is now locked in a standoff. And the referee in the middle of it all, the central bank.
The whole fight is over something called open banking. Put simply, it's a set of rules that would force banks, with your permission of course, to share your financial data with a licensed fintech company through a secure digital connection. For these fintech lenders, this is the holy grail. It would let them instantly and accurately see a business's real financial health.
And this is where you get the central conflict. On one side, you have the fintechs. They're often backed by venture capital. They're built for speed. They need to get to market, and they need to do it fast. On the other side, you have the big banks and the regulator, Nepal Roster Bank, and their focus, rightly so, is on stability and caution. They look at open banking and see a potential threat to data security and the way things have always been done.
But this caution creates a really dangerous paradox.
By moving too slowly, by letting the banks stall, the regulator actually risks pushing all this innovation outside of the formal system. The fintechs will just find workarounds, they'll create their own closed-off lending systems, and what's the result? You get a shadow financial system that's far riskier and much, much harder for the central bank to actually keep an eye on.
So this standoff, it leads us to two very different potential futures for Nepal's financial sector, looking ahead to the year 2026.
All right, in scenario one, let's call it accelerated integration. The regulator acts decisively. They mandate clear, open banking standards. The banks, instead of just playing defense, they go on offense, partnering with fintechs. What you get is a stable, integrated credit market that safely and efficiently closes that billion-dollar gap. But what happens if the whole process just stalls? Well, then we get scenario two, the protracted Cold War. Here, the process just drags on and on. The fintechs eventually give up on cooperation and just build their own closed systems. You end up with a fragmented market full of competing silos. Now, the gap might still close, but it happens with way more systemic risk, leaving the regulator constantly playing catch-up.
So, the key takeaway here is that neither of these futures is set in stone. The path that gets chosen will be decided by the actions of regulators and banking leaders in the very, very near future. And that really brings us to the ultimate billion-dollar question. The technology to solve this credit gap, it's already here. The fintechs have built the engine. The only question left is whether the country's established financial institutions and regulators are going to give them the fuel, the data, and the license to actually turn it on.
In the end, the source material leaves us with a pretty hard truth. The biggest obstacle facing Nepal's economic future, it isn't a lack of money or talent or technology. It's a crisis of institutional will. And that single choice is what's going to determine the fate of a billion-dollar market.